Welcome to Yahoo Finance Live. I am Shauna Smith. Happy Monday. Let's get you up to speed on the market action with 60 minutes to go in the trading day. We're not too far from the flat line. You can see the Dow just down about 7 points here. S&P barely holding on to gains. The Nasdaq also essentially flat. Of course, the headline of the day, JPMorgan acquiring the assets here of First Republic. JPMorgan, the top performer inside the Dow today, with shares up just about 2%. When you take a look at the sector action today, outperformance coming from healthcare and industrials. On the flip side, the underperformers in today's market: energy, consumer discretionary, as well as real estate. Let's get you up to speed on that top story of the day. JPMorgan acquiring First Republic Bank. Yahoo Finance's David Hollerith is here with those details. Hi, David.
Hey, Shauna. Yeah, so it was a pretty busy weekend for a lot of major banks who had been invited by the FDIC to put in bids for First Republic. Obviously, we saw on Friday that there were reports coming out that First Republic's seizure by the government was imminent. Was following their earnings that showed their deposits drop in the first quarter. But anyway, over the weekend, JPMorgan had more than 800 bankers working in its Manhattan headquarters office. And during that time, essentially the entire senior management was there, and they were hearing from all different parts of the bank, from the investment banking side to, something like the mortgage specialists and the tax advisors, and they're all weighing in basically to figure out what the value of First Republic is to the bank, and also what they want to offer to the FDIC. And you can imagine this was going on at other banks that were considering placing bids or had placed bids. So it was very interesting to watch all this unfold. I'm sure leading up to the deadline on Sunday, there were several banks that did place a bid. By about 7 p.m. last night, it was whittled down to about 3. JPMorgan found out that their offer had been accepted by the FDIC a little after midnight last night.
All right, Dave, thanks so much for the latest on that. Of course, the fact that despite the fact that we did see the failure of First Republic, the street is still betting that the Fed is going to keep going and raise rates. The latest Fed funds future showing a 90% chance of a 25 basis point hike this week. But is that the right move? We want to bring in Kevin Flanagan, Wisdom Tree head of fixed income strategy. Kevin, it's good to see you here. So let's start with the Fed. The implications, another bank failure here this year. Do you think it's going to have any impact on what the Fed does on Wednesday?
No, I really don't. I think what the Fed's looking at, if you just go back to the minutes for the March meeting, you can kind of, dive in a little bit into the inner thinking of the voting members, is they're looking for any kind of strains or stresses in the funding markets. And quite the opposite. Actually, the funding markets are beginning to show some signs of alleviation of the pressures that we saw in March following Silicon Valley Bank and Signature Bank. So as long as I think the Fed sees the plumbing, for lack of a better way of putting it, is in order, that they'll give us that one more quarter point rate hike.
Yeah, Kevin, so it sounds like, is this essentially already priced into the market? And then do you think it sounds like maybe get a pause after this meeting?
Yeah, it's going to be interesting. We've been finding out that when the Fed meets, the policy statement tends to elicit a market reaction, and then Powell speaks and we get a whole nother market reaction. So the Fed's communication skills are really going to come under the microscope, I think, as we move forward, because it's no longer this thought process, are they going to, raise rates by 25, 50 or 75? It's what are they going to do next? Are they going to go on hold? When could they consider cutting rates, which we don't think is going to be the case for a while anyway. So it's going to be interesting to see how the Fed communicates this going forward. I think they want to keep their options open and have some flexibility. I don't think they want to pigeonhole themselves with the policy statement on Wednesday.
Kevin, in order for the Fed to potentially cut rates later this year, what needs to happen? What is that likely catalyst to get them to do so?
Well, I mean, for them, it's inflation, right? They keep telling us there's more work to do. Now, that doesn't necessarily mean more rate cuts, but it does mean keeping policy on hold, 5 to 5.25% Fed funds for the foreseeable future. So I think we need to see definitive signs inflation is getting closer to their threshold of 2%, not necessarily getting to 2%. But more than what we've seen now, I mean, their preferred measure of core inflation last week was still what, 4.5%, 4.6%, somewhere around there. So there's a lot more wood to chop for the Fed. So that and some softening in the labor markets, I think, gets us to the Fed talking about rate cuts. I don't know if you remember that with rate hikes. That was another one of Powell's famous lines.
I certainly do. Quite a few meetings ago. Kevin, let's talk about what the bond market is signaling, because for quite some time now, the bond market has been signaling a recession, and it doesn't seem like we have seen that yet. Do you agree? And I guess, how likely do you see a recession here within the next 6 to 12 months?
Well, yeah, right. The classic bond market ghouls, bad news is good news. So there seems to be a decent amount of that bad news priced in at this stage of the game. So you kind of wonder, how much lower can yields go in the environment that we've been seeing? I know they've popped up a little bit today, but just recently you had a 2-year Treasury yield under 4%, which is kind of strange considering you have a Fed funds rate at 5%. Moving forward. So I think as we move into the second, third, maybe for fourth quarters, should investors expect to see a 0 or a negative real GDP reading? I think that's a reasonable case scenario. I mean, we were there last year, right? We had 2 consecutive quarters of negative GDP. So it's not as if we haven't been there before. I think the question is going to become not whether we get a negative GDP report, but by how much.
So Kevin, what does all this mean then for investors? How should they be playing this pretty uncertain environment?
Well, in the bond market, right? I mean, looking at the yield curve, it still remains incredibly inverted. You're not being paid to move out on the curve into duration. So we continue to like Treasury floating rate notes in that aspect of things, and also high yield. It's interesting, even though we were talking about recession, a quality screened high yield, I think, option also makes a lot of sense for that core plus, because as we said, much like the Treasury market, what you're seeing in other fixed income markets does seem to be some pricing in for the potential for a recession and even higher default rates. So you're getting a coupon at 8, 8.5%, 9%, a lot of cushion there in the high yield market.
And Kevin, when it comes to some of those other concerns out there, of course, weakening corporate profits is something that investors are watching. We also had the debate down in D.C. over the debt limit. How are you calculating that? How are you factoring that into your assessment, into your outlook here over the next 6 months?
Yeah, I mean, on the earnings front, right? I mean, people are debating, is it going to be an economic or earnings recession or both? I would imagine with the slowdown that most of us are anticipating, you do expect to see some impact on the earnings side of the equation. But from the debt ceiling perspective, that's a whole different scenario that we're talking about now. I mean, we saw last week the Republicans come forward with a plan. Hopefully that begins negotiations within the Biden administration and we move on from there. But I think there's a lot of headline risk moving forward. And, for lack of a better way of putting it, it's going to get messy. But I do think ultimately they do come to an agreement and raise the debt ceiling, or just push the can or kick that can down the road.
All right, Kevin Flanagan, always great to get your perspective. Wisdom Tree, head of fixed income strategy. Thanks so much for joining us here this afternoon.
Thanks.
Well, we are just getting started on Yahoo Finance Live. Coming up, more reaction to JPMorgan's move to rescue First Republic Bank. We'll hear from Citigroup CEO Jane Fraser ahead. And is Mercedes set to take control of the luxury EV market? We talk with the company's U.S. CEO later in the hour. And coming up, we catch up with Brian Sozzi live from the 2023 Milken Institute Global Conference as he sits down with the CEO of Mattel for a check on the consumer. You won't want to miss that.
We've got a huge week for investors, big-time corporate earnings, a potential writer's strike in Hollywood, and oh yeah, the Federal Reserve's got a major decision on interest rates. Here are the 3 things you need to know for the week ahead.
Markets are bracing for some major earnings. Apple, Ford, Starbucks, and AMC are just a few of the top companies reporting quarterly results. Those will give us a fresh look at the health of American business. Plus, Hollywood's movie and TV writers could walk off the lot as early as Tuesday. The Writers Guild of America has voted in favor of a labor strike, giving studios until May 1st to agree on a deal. If a strike occurs, production of some of your favorite TV and film franchises could be delayed. And last, but definitely not least, the Federal Reserve makes its decision on whether to continue raising short-term interest rates. Signs of a slowdown in the U.S. economy could give the Fed reason enough to pause on their current rate hike policy. We'll hear from Chairman Jerome Powell on Wednesday. We've got you covered all week right here at Yahoo Finance. And be sure to tune in to After the Call on Tuesday and Thursday for a breakdown of some of the big earnings reports.
JPMorgan Chase stepping in to buy First Republic's assets after the failed regional lender was seized by regulators. Now, the acquisition includes $173 billion of loans and $30 billion of securities. And also the stock, First Republic, is going to be delisted as a result. Yahoo Finance's Josh Schaefer following this story for us. And Josh, you've been digging into the implications here for First Republic shareholders. What did you find?
Yeah, so it depends on what we're looking at to some extent too, right? So we should make clear. First, we'll talk about the institutional investors. And so a key distinction in what happened today is JPMorgan did not assume First Republic's corporate debt or preferred stock. Those are usually institutional investors. So those investors are not going to be made whole. Now, on the retail side, those stockholders now need to go to the FDIC. So that's the key difference here between, say, JPMorgan just buying First Republic. JPMorgan did not just buy First Republic. First Republic was seized by the FDIC, and then JPMorgan bought some of the assets from the FDIC. So First Republic shareholders now need to go to the FDIC and file a claim. And really, Shauna, what the sad part is here for stockholders, for those retail investors, is they'll be 4th on the list of 4 for creditors of people that get paid out. They are at the bottom of that list. You can see stockholders, they are coming in at 4th, behind depositors and behind some other creditors as well. And one other thing that I wanted to point out is, so while they can file, analysts are already saying the likelihood of people getting their money back is really just unlikely here. Wedbush said that they expect a, quote, wipeout of common shareholders.
Yeah, which is crazy. When they started this banking crisis, right around $115 a share. Josh, when it comes to JPMorgan taking over First Republic, CEO Jamie Dimon making some interesting comments, maybe you can put it that way, about the future of the brand. And the brand, it doesn't sound like, has a future at this point.
He said the brand is going to eventually be gone. So what's happening right now today is First Republic banks are open. Your deposit should be in there if you were using First Republic, but eventually that bank is not going to have First Republic's logo on it, and you're not really a First Republic customer anymore. You are a JPMorgan customer. And one other thing I did want to point out, Shauna, that while we're talking about the retail investor, you sort of just brought this up, is just, I think it's interesting to take a look at that chart over the last month, 3 months, year to date. When you think about First Republic stock, that stock was trading at $115 back on March 8th and March 9th before this crisis started. So really it was a legitimate stock to hold. And I think that's an important part when we talk about what eventually happens to retail investors here, is to always sort of know what you own, right? And that has really crumbled in just less than a month. And I think it's relevant that it's not, First Republic wasn't a meme stock 2 or 3 months ago. This was a real crisis that played out, and something that you can follow along with in the news sort of as that stock price drops, because it certainly has absolutely dropped, and it closed today at $350 and won't ever be open again.
Yeah, it's astonishing really to look at that chart, see where it ended trading as of Friday afternoon, stopped trading today, and where it was just about a month and a half ago, not too long ago, 6 weeks ago, at just around $115 a share. Josh, what about just the investor story here? Because I think going back to kind of the windfall, what has been the last 6 weeks, lots of questions about the stability of the banking system, the risk here for regional banks. But when you take a look at the broader market action, the 3 major averages, they're not too far from the flatline. And when you take a look at a lot of the individual movers stay inside the regionals, we're not seeing that massive drop that we saw after Silicon Valley.
You're seeing some confidence in the market that this was a First Republic problem at this point. And Jamie Dimon pretty much said as much of this. He said you'll probably see a little bit more fallout, but generally, I mean, he had that broad quote that everyone's talking about today, that the crisis is over, right? And so I think that that's what you're seeing play out in the market right now. Was First Republic might have been, at least for now, the final regional shoe that people were really concerned about. And it's something that's been baked in too, right? They announced that $100 billion deposit loss last Monday. The stock tanked over the last week, but really it had been falling, like we said, for a month now. It had been in focus since they got that big loan borrowing from those big banks. So it wasn't a new, surprising story, and it certainly is promising to see the other regional stocks, as you said, holding up for now.
Yeah, it certainly looks like investors are at least looking at this as an isolated event. All right, Josh Schaefer, great stuff. Thanks so much. Coming up, we will go around the horn with 3 trending stocks that we are keeping a close eye on ahead of today's closing bell. You look at Norwegian, Lordstown, and Disney. We'll be right back. It's time for a triple play. 3 stocks that we're watching in the final 30 minutes of trading. We've got Norwegian, Disney, and Lordstown. Let's kick it off with Norwegian here. Investors are buying after its latest quarterly results. You can see a gain of just about 8.5%. The cruise line's losses have narrowed. The street likes that. Also, its sales more than tripling from a year ago. And that's not all. Passenger ticket revenue up more than 250%. A number of analysts that are covering the stock here applauding this report. That includes Stifel. In a note to clients, a team there saying that it's most encouraged by Norwegian's booking commentary, as well as the progress that the company is making on some of its cost-cutting efforts. So still has a way to go here, Pros, but certainly it seems like, especially within the commentary here on this earnings call, that things are trending in the right direction. Yeah, I mean, tripling their sales year over year is huge. Talking about how they have see-through with bookings on airfare and how a lot of customers book airfare along with their cruise tickets, and seeing the airfare sort of notching higher, so they can see that those prices are coming up. People are still buying. Cruising is still a very popular activity, but also cost controls, right? Are they able to control these big costs, fuel and whatnot, as people cruise more?
Yeah, and I think, higher demand, higher ticket prices, that's causing them to lift their annual profit forecast as well, which is always a good thing when you can have stronger than expected guidance. Norwegian CFO did say that will be offset by a strong dollar, higher fuel costs. But overall, this is a positive story, especially in the face of inflation, where we're seeing a lot of consumers pull back. But considering, pandemic restrictions are easing, we're seeing that upper income consumer wanting to go out and travel, and cruises are one of those options.
Yeah, cruising coming up, but Lordstown kind of on the way down here. I'm watching Lordstown Motors.
Big way down.
They are going down. Well, we'll see. The EV maker hitting a new low today after the company said it's in danger of going bankrupt. Why? Its partner Foxconn is threatening to withhold important funding because Lordstown received a delisting notice from the Nasdaq, which is a breach of contract between the two. Now, Lordstown says Foxconn is making a good faith effort to follow through on its deal here to make a low cost EV. But the fact of the matter is, if Foxconn withholds payment, Lordstown will likely to cease operations and file for bankruptcy protection. So, not looking good. Their shares well below $1 for Lordstown.
Yeah, and this is just not a good story. I'm going to read a quote from the filing because this just paints the dismal picture. Lordstown alleging that without this deal, quote, the company will be deprived of critical funding necessary for its operations. Critical funding necessary for operations. That just does not sound good. And then if you take a look at the stock, it's down 70% year to date, more than 85% year over year. It just seems like shareholders were really looking at this agreement to help boost shares, to help save this company. Now we have that threat of bankruptcy, and it comes after the company lost $100 million in the fourth quarter alone. So not a good sign at all, but Lordstown did say that it expects Foxconn to hold up its end of the bargain, and if it does not, then they are going to seek other alternatives, both legal and financial.
Yeah, certainly they said that they were seeking those two alternatives if in fact they were faced to make that decision. Lordstown is really hoping that Foxconn holds up its end of the deal because, Ali, you mentioned that massive drop that we've seen within the share price here. It's been trading under $1 since March. We also know that in February they announced that they were halting future production here, future EVs production, and also just in terms of deliveries of those future EVs. It's in a very tough spot. And I'm curious, Press, just to get your take on this, just its ability to succeed at this point, given the fact that competition is becoming even stronger here. They're losing any sort of footprint that they had in the market, and investors are finding a lot of other names to get excited about.
I mean, and they had some first mover status there, but they sold their factory to Foxconn. Foxconn owns their factory, so if they can't get them on board, I don't know where they're going to build these endurance pickups. This is a big problem for them. They had about $200 million in cash at the end of the quarter, but they've already burned through $100 million last quarter, so this is a tough spot for them. They need that money to get those EVs out the door.
Saga between Lordstown and Foxconn, and also a saga between DeSantis and Disney. My triple play for today, another development in that ongoing battle with Florida Governor Ron DeSantis. The Oversight Board countersuing Disney on Monday after the media giant filed a lawsuit last week alleging DeSantis launched a, quote, targeted campaign of government retaliation against the company, which Disney says violates its free speech. This tit for tat comes shortly after the board passed a resolution to nullify Disney's last-minute agreements that allowed it to retain control of its long-standing special tax district, formerly known as Reedy Creek. Of course, this all stems back to Disney's unfavorable response to Florida's Parental Rights and Education Act, otherwise known as a Don't Say Gay law. Shares, they're fairly muted in afternoon trading, so it seems like shareholders, at least right now, are shrugging this off, but you have to wonder the impact this could have from a PR perspective and a branding perspective for Disney moving forward, and then obviously with Governor DeSantis. He has not announced his run for presidency, but this is just not a great look.
Yeah, it's certainly not a great look, and I think Governor DeSantis is kind of learning that it's going to be a little bit tough, and it is a lot tougher than maybe he initially thought to take on a company the size of Disney. When it comes to the investor side of the story, largely investors have been shrugging off anything related to the Disney versus DeSantis feud. We haven't really seen a massive impact here on share price. I wonder whether or not that is going to stay the course here. But when it comes to DeSantis, he has a heck of a lot on the line. Like you were saying, Ali, if in fact he does declare that he is running for president for the Republican nomination here in 2024, voters, could potentially take issue with this. There has been a number of recent polls here talking about how people are interpreting this feud between DeSantis and Disney. And the latest one here from Reuters, finding that less than half of Republicans had a favorable view of DeSantis because of his fight with Disney. So DeSantis could be losing this battle here on the bigger stage.
Yeah, it's the whole thing. Are they pro-business or not? But I got to say, I don't know if you guys watched the White House Correspondents' Dinner on Saturday night where Joe Biden said, he's going to take some hits on DeSantis, but Mickey Mouse is already doing that. So, not a good look for him. And also, but Disney so far unaffected right now, right?
Disney has been unaffected. We'll see whether or not that remains the case. All right, Ali Pross, great stuff. Thank you. Coming up, we check in with Brian Sozzi over at the Milken Institute Global Conference with a look at his sit-down interview with Citigroup CEO Jane Fraser. We'll be right back. JPMorgan Chase coming to First Republic's rescue. The Jamie Dimon-led bank emerging as a buyer of First Republic after the regional bank failed over the weekend. Citi CEO Jane Fraser is saying that these particular banks were poorly managed and that the U.S. banking system overall is solid. Fraser making those comments on a panel alongside other financial leaders at the Milken Institute Global Conference in L.A. today. My colleague Brian Sozzi is at the Milken Conference. He had the opportunity to speak with Fraser herself. Brian, it's good to see you. What else did you have to say?
Good to see you guys as well. So we found Citi CEO Jane Fraser in good spirits, despite a very large competitor in JPMorgan getting a lot stronger, notably in the wealth management business as it acquires First Republic in what many sources have told me here is a sweetheart deal for First Republic. But I asked Jane Fraser her views on that deal, the outlook for banking, and what it all means for Citi.
There's a palpable sense of relief from everybody this morning because it's sad to see a bank fail, for sure.
You must have read my notes, right? Because I was going to start with that. This is a remarkable day in the banking space. Things that you've seen before, I've seen it before, covering financial services. Just your thoughts. How big a sigh of relief is it?
Look, I think this was the last remaining main uncertainty of the small handful of banks that did not do a good job with asset liability management, and also, were the victim of the steepest rate curve increase we've seen in 40 years. But nonetheless, it is a small handful. And as we look at the overall U.S. banking system, this is a strong, this is a safe, this is the envy of the world. And it's easy at moments like this to forget that. Each of the banks have got its role to play. The global banks like ourselves play a leading role in the global capital markets and financial markets. The national players, the regional players, the smaller banks, all serving different client bases with different scale, different purposes. But this system works, and I think we've all been grateful as the large banks to be in such a strong position as we were during the pandemic, and we have been in the recent turmoil, to be able to step in and play our part supporting clients and the markets.
To the average investor out there, and as someone who lived and operated through the great financial crisis, does this feel like that? Does this resemble anything from that situation more than a decade ago?
Not in the least. This is very, very different. I think that the banking system, and I can speak for our own bank, much simpler, much more focused business model. We have a diversified and very resilient business model. A lot of clarity who we are. Our credit position is very strong. 90% of our international exposure is investment grade. 85% of our entire corporate exposure is investment grade. 80% of our portfolio is prime on the consumer side. So this is very different for the large banks. This is different for the system overall. Consumer is in good health. The corporate is in good health. We do think we are probably heading into a recession at the back end of this year. There is likely to be credit tightening. There's some stresses ahead, commercial real estate and the like, but this should be manageable.
How do the mechanics work? So you were part of that consortium of banks in March and invested, $5 billion in First Republic. What happens to that money?
Yeah, so let's spend 1 minute on how remarkable that in a little over a day, the 11 largest banks in the US system get together and put $30 billion at a point where there is a confidence crisis going on in the market. In just over a day, put that in to buy the time for that crisis to pass and for a solution to be put in place. That's quite remarkable. I think we should all feel proud that that's what happens, and also take a lot of comfort from that position. Now I think we all move on, and we were buying time, not a solution, to the First Republic situation, and the regulators did what they needed to do, and they've clearly got the situation addressed, and now we move forward.
What is this deal? You essentially now have a competitor getting larger. What does that mean to a Citigroup?
Look, I think you're seeing, as I said at the beginning, you see different banks playing different roles. And there's a tendency to think about the large banks only in the domestic context. We play a critical role globally. Our own institution moves $4 trillion of volume daily. That's the GDP of Germany daily for 5,000 multinational companies around the world. And so there is a very, very important role that the US capital market plays in the global financial system. It is the envy of the world, but it plays a critical stabilizing, innovative force, and is a mainstay of the global economy and financial system. So let's understand the roles that different players play, and be grateful that the system works as well as it does.
Do you see more consolidation in the regional banks?
I think we'll see more consolidation in amongst the smaller institutions, because it's likely that the minimum efficient scale will be rising. But there are 4,700 banks in the US. That's a lot.
That's a fun fact.
There is room for consolidation here without big structural changes to the core strength of the system. So yes, I do expect to see some consolidation amongst those players. That's probably a good thing, but I think it's important not to over-exaggerate it either.
Is it fair to say this crisis is over, or is there multiple innings to it?
Certainly this phase is over. Tell me what happens to the debt ceiling, and I will give you a sense as to what lies ahead. Well, at the moment, the market's got a sense of humor failure over the debt ceiling. So we're seeing, earlier than we have done before, the concerns starting to play out in Treasury. Some of the pricing for June through September is certainly coming off. The CDS spreads are wider. So there is rising concern here. I'm not going to comment on the politics. That's up to the politicians to do their job. But the consequences of a problem there are very dire. And it really is the last thing that we need right now in the world, is America to default on its debt. So let's hope it does not come to that.
So investors should be paying more attention to that issue than you would think in the markets, or at least the markets are showing at this point?
We're starting to see the investors paying more attention to it. So I think that is happening much earlier than it's happened in the past. And I hope that will act as an impetus to get this resolved in a bipartisan way.
Jane, where is Citi's transformation?
Oh,
I've been telling my team that Citi has put up, let's say, 3, maybe 4 good quarters in a row, and you do get a sense things have turned the corner with Citi.
Well, we're a bank on a mission. We're very clear about who we are. We are the bank to be the preeminent banking partner for institutions with cross-border needs. Full stop. That's it. It's a very simple strategy. It's one that makes the bank more focused. The businesses we have, the 5 core businesses, connect very well together in serving that client base. It makes the bank less risky. It will make the bank with a resilient, diversified business model, as we've seen over the last few weeks, that's panned out well. And one where it will drive our returns, because I need to meet our medium-term return targets that we've laid out. We'll then be wanting to meet longer-term targets, which we'll set subsequently. We're just getting it done, and there's real urgency behind it. We've closed now most of the divestitures we need to do in Asia. We'll have 2 more we'll close at the end of the third quarter and the fourth quarter. So we'll be able to really simplify the bank's organization structure after that as well. And single-minded purpose. We know what we are, we know what we need to do, and we're making good progress getting on with it.
An interesting day, of course, for Citi, because as you heard from Jane Fraser right there, they have done a lot of good things to improve the culture at the company, to improve the earnings power of the company. They've done this by cutting expenses, leaving businesses that maybe not as profitable as they would have liked. But again, you are now, if you are Citi, you see a competitor in JPMorgan that got a great deal on Washington Mutual during the crisis, got a great deal on Bear Stearns during the crisis, now another good deal with First Republic. And like we heard from other folks here at the conference, the strong are only getting stronger, and that strong bank, not that Citi isn't, but that strong bank, that dominant bank, at least in the US it is, appears to be a JPMorgan, while Citigroup is a little more focused, or at least it appears, based on what we heard from Fraser, more focused on that multinational opportunity.
Yes, Ozzy, great interview there. I thought it was very interesting just what Fraser had to say about the turnaround efforts, where Citi has been successful over the last several quarters. I also love, though, what she had to say about JPMorgan coming in and buying First Republic. She said that it was a sense of relief here, and it's only a small handful of banks that are in this position, something similar to what we heard from Jamie Dimon when he was on a call with analysts, with investors earlier today. So given the sense that this is a positive here, not only for JPMorgan potentially, that's like up just about 2% today, but more broadly speaking for the stability and more so the confidence that a deal like this brings back and restores here for the banking sector.
Well, Shauna, there is no other alternative. The alternative is this bank doesn't go to JPMorgan, it fails, and then you see contagion spread to more regional banks and then the big banks like a JPMorgan, Citigroup. I think what you've seen throughout this banking crisis or turmoil, whatever you want to call it, over the past month and a half, 2 months, is that regulators are willing to step in and other big banks are willing to step in here, get these deposits, and ultimately save the broader financial system from the mess that was the great financial crisis.
Yes, sir. Certainly investors very encouraged by the steps that we have seen from the big banks over the last 6 weeks or so. Brian Sazzi, great interview. Thanks so much. All right, coming up, travel demand is strong. One airline saying that it is off to an encouraging start this year. We're going to speak with the CEO of Hawaiian Airlines on the other side of the break. Let's do a quick check of the markets. About 18 minutes to go in the trading day. And you're now looking at all three of the major averages trading to the downside. The Dow off just about 0.1%. The Nasdaq leading to the downside here, off almost just about 0.2% here in terms of the sector action. Underperformance coming from energy, consumer discretionary, and real estate. Those three sectors, the worst performing sectors of the trading day. All right, turning to the travel industry and demand, it looks like it's staying strong here. Hawaiian Airlines is the latest of the group of airlines to reaffirm that people are eager to go on vacation. The airline beating on both the top and bottom lines in this most recent earnings report, helped in part by demand for domestic leisure travel. Here to discuss, Hawaiian Airlines CEO and President Peter Ingram. Peter, it's great to see you again here, and congratulations on what was another strong quarter here from the airline. In the earnings call, I was reading through the transcript, and you characterized the start of this year as encouraging. What does this signal not only for the current quarter, but looking out to the summer travel season?
Well, thank you very much. It's good to be with you. We're really encouraged that demand is strong in the vast majority of our markets. We've seen a strong recovery over the last couple of years. The first quarter, especially January and February, is a little bit of a seasonally weaker period for leisure travel after the holidays and before spring break. But our revenue was on track, a little bit above what our original guidance was for the quarter. We've seen good demand from our largest market, which is the U.S. mainland, to Hawaii, and we're really encouraged about the outlook for the rest of the year.
Peter, you also did the warn of several operational challenges. How do you see this affecting your path back towards profitability?
Well, I think there's a couple of things in the near term that we're going to have to be dealing with, and we talked about those on our financial results call last week. Specifically, there's been a construction project here in Honolulu to refurbish the main arrivals runway at the airport. That has been ongoing since October. It's been delayed a couple of times, and we've got about one more month to go. It's on track, hopefully, to be completed by the end of May. And that's really disrupted particularly our neighbor island flights, the highway system between the islands of the state of Hawaii, where we've had air traffic control delay programs in place on an almost daily basis. We've made adjustments where we can, but it's not enough to overcome it. And that is something we're looking forward to being completed as the construction project completes. And then the other challenge we talked about is the availability of engines for our A321 Neo fleet. That is something that's been ongoing for several months now, as the supply chain challenges faced by Pratt & Whitney, the manufacturer of those engines, has meant that we've had a handful of airplanes grounded at various points during the period. We're hoping to see some improvement over the next couple of months, and we just had a couple of aircraft in the last week or so go back into service. But these are the sort of operational challenges that our guests expect us to solve. And so we're working very hard, and our team's doing what they can to mitigate any impact on their travel plans, especially as we get into the busy summer travel season.
So, Peter, that timeline of returning to profitability, what do you think, I guess, that realistically looks like at this point, given those challenges?
Well, I don't want to put a specific timeline on it. I think we're going to see better results over the next couple of quarters as we move into a more peak period of the year. We've got a couple of idiosyncratic challenges related to the markets we serve, particularly with Japan outbound leisure travel, which was a little under 20% of our business before the pandemic began, and with some of the pricing in our neighbor island market. I am encouraged that we have seen some green shoots of life from the Japan travel market, and we've started to see a little bit of signs of demand picking up. It's still a long way from where it historically has been, but I think there's a great affinity for Japan travelers to come to Hawaii, and that is going to be resilient over time. And we expect that to recover as we move through this year and into 2024. And we think 2024 we're set up, much better with changes in a couple of parts of our market that we expect to continue to have some room for recovery.
Yeah, Peter, what are you seeing just in terms of pricing power and whether or not that's going to hold this year? You mentioned the fact that you are under some pressure from some of your competitors out there, what they're offering, also some of the, I guess, slower rebound that you are seeing out of your Japan travelers. Are you able to price where you want to price, and how do you see that trend continuing this year?
Well, the industry is very competitive, and that's been true for my entire career. We've got to deal with the market conditions that exist, whether it's North America to Hawaii and the neighbor island markets or internationally. Our team has done a very good job of responding to that. Our frontline teams deliver outstanding service and hospitality, and generally, when the prices are where prices will be in the market, but when people have a choice to fly Hawaiian Airlines in the markets we serve, that's who they want to fly, and that's what they choose. And as long as we're outperforming our competitors, we believe over the long term we're going to be successful, and I think we continue to do that, and we've got a bright future.
Speaking of your competitors, a number of your competitors have not been able to reach a new contract with their pilots. You did back in February. What are you seeing from that perspective, the edge that this potentially gives you? And where do things stand on the staffing shortages, the challenge that I know has not only affected you, but all of your competitors within the space?
Well, I'm very pleased with where we are right now on from the standpoint of our labor relations. We have negotiated new contracts since the beginning of the pandemic with all of our major collective bargaining groups, culminating with that pilot agreement that was reached in the early part of this year and ratified at the beginning of March. So we don't have any amendable contracts until 2025 at this point, and that's, I think, an enviable place to be, where there's continued uncertainty on some other properties with regards to the labor outlook. We've got a picture of what our cost structure is. We've got competitive rates for all our labor groups. Right now, we're able to hire the people we need. We did a lot of hiring over the course of 2022 as we rebuilt our airline, and I feel very good about where we are right now. That's not a constraint at all for us. We've worked through some of the challenges we faced in our training backlog last year. There were a couple of specific areas around certain airports where hiring ground staff is tough, and we'd like to still recruit more mechanics, but by and large, labor availability is not something that's troubling us right now based on where we are.
Great news there for your business. Peter Ingram, CEO and president of Hawaiian Airlines. Always great to have you. Thanks so much for joining us.
Thank you.
All right, coming up, Uber set to report earnings tomorrow. We will take a look at the estimates and break down what you need to watch. Stick around. Taking a look at Uber ahead of tomorrow's earnings report, looking at shares up nearly 6% here with three things to watch from this ride-sharing company. We want to bring Yahoo Finance's Dan Holley. And Dan certainly has been off to a strong start this year. What do investors need to keep in mind tomorrow?
That's right, Shauna. Those three things basically can be broken down into delivery, mobility, and, I know this might sound weird, a potential increased threat from Lyft. Now let's go over the continued growth in mobility. Let's look at the big numbers first. Revenue, we're expecting $8.7 billion versus last year revenue of $6.9 billion. Adjusted loss per share is expected to be 8 cents. That's compared to $3.04 last year. As far as mobility goes, we're looking at $14.8 billion gross bookings expected. That's compared to the $10.7 billion last year. And you can see that this kind of continued growth in the mobility section, which was really hammered during COVID, is expected to continue moving forward. So that could be a really good boon for Uber. The other piece of the puzzle is difficulties in deliveries. And deliveries really acted as the kind of godsend for Uber during COVID. It was the way that the company really continued to make money. People were ordering, sure, nobody was going out on the road. So it was up to the Eats, previously called Eats, now delivery business. That's expected to bring in $14.9 billion compared to $13.9 billion in 2022. And the idea here is that if we see waning consumer confidence, if we see people starting to pull back on spending, well, getting food delivered is pretty expensive. I think one of the analysts that I was looking at pointed out that it's as much as a 35% increase to the food price just because of tips and delivery fees. So, if people are pulling back, we could see issues there. And then, the Lyft idea, the thesis here, just bear with me, is that new CEO, obviously speaking to our own Brian Sozzi, saying that they want to be more competitive. That could mean that pricing could become more competitive between Lyft and Uber. And so if people start to see that Lyft offers a better opportunity for pricing, you're not going to have to pay as much when you're traveling, especially when people are being more cost conscious. It could prove to be a bigger threat to Uber than it has been. But again, Uber has its ads business, its mobility business, its transport business, and obviously the regular ride. So I don't necessarily think it's going to be a huge problem for them moving forward. But, it's something to watch for.
Certainly something to watch. Again, shares up 33% since the start of the year. Dan Holley, great stuff. Thank you. Coming up, we are counting down to the closing bell on Wall Street. Again, you're looking at losses across the board just below the flat line. The Dow now off just about 50 points. We'll be right back. Under 2 minutes until the closing bell on Wall Street. Ness Frey with a closer look at some of today's movers. Hey, Ness.
Hey, Shauna. Yeah, and we lost some of that buying that we had earlier today. Take a look at the Dow right now. It's down about 0.1%, down about just 31 points. But you can see that earlier it had opened today in the green, lost some steam along the way. Same situation, a little bit with the Nasdaq, and then the S&P 500 just hugging the flat line right now. Taking a look at our sectors, we have been seeing energy stocks, which have been underperforming throughout the session, as well as consumer discretionary real estate. We do, though, see that you've got healthcare, industrials, utilities in the green. Over on the Dow, well, JPMorgan up more than 2%, the best performer on the Dow today after acquiring a First Republic. Also taking a look at the Nasdaq 100. We've been watching Amazon down more than 3%. I had mentioned consumer discretionary was one of the lagging sectors. Amazon is within that consumer discretionary sector. We have been watching, though, NVIDIA up more than 4%. And just taking a look at where we're at with those bank stocks, I had mentioned earlier, JPMorgan, Wells Fargo up more than 1.5%. But you do see pressure on some of the other bank stocks, and on the regional banks, quite a bit of pressure on the regional banks as well. I just do want to point out what's been happening with the here's the closing bell.
All right, well, that does it for today's trading day. Again, all three of the major averages ending just below the flat line. We're looking at the Dow closing off just about 50 points, S&P in the red, as well as the Nasdaq. So losing some of the momentum that we saw last week, driven in part by some of those beats on earnings that we have been getting over the last couple of weeks. This market check sponsored by FlexShares. Again, all three of the major averages in the red. Underperformance from energy and consumer discretionary, the worst performers of today. Let's take a look at some of the biggest business stories and also movers for today. And for that, we want to bring in Ray Wang, Constellation Research principal analyst and founder. We also have Yahoo Finance reporter Josh Schaefer here jumping in. All right, guys, lots to get into. Let's first start with the biggest story of the day. I think you can call it that, at least business story of the day. JPMorgan closing the day in the green, up just about 2%. Now the stock trading to the upside after the bank agreed to acquire First Republic. The regional lender's collapse is the second largest bank failure in the U.S. And right, when you take a look at the fact that JPMorgan closed up just about 2%, some confidence there returning to the market that maybe the stress that we saw within the banking sector is now behind us.
Yeah, no, we're definitely thinking that, JPMorgan got the best part of the deal. It's the best clients on the wealth management side. The big get bigger. And I think we've got a little issue with the smaller banks and the regional banks. And so the confidence hopefully is there. And hopefully the smaller regional banks will have a way back. But right now, they've got a great wealth management portfolio.
And Ray, I think part of what you're seeing here, too, just as far as today's stock action, when you think about JPMorgan and sort of their area in the banking sector, right, kind of as one of those bigger banks. So for there to be such confidence, or for them to exude such confidence about the crisis sort of being over, we've heard similar comments today as well. Should point out that Citigroup CEO Jane Fraser told us this is not the great financial crisis. This is not the savings and loan crisis. So to have multiple banks coming out and being so positive about where this could head eventually, I think that, Shauna, probably too also propels JPM shares, just when you think about JPM in the broader banking space sort of being one of those top dogs.
Yeah, certainly some very optimistic comments coming from Fraser during her interview here with Yahoo Finance's Brian Sozzi. She said that the U.S. banking system is the envy of the world and that this deal provides really a sense of relief for the industry, and I certainly think you saw that reflected in the bank shares today. All right, let's move on to SoFi. It's a trending ticker on Yahoo Finance, a fintech company closing down just about 12%, despite the fact that it beat on first quarter earnings. Investors may be worrying that the worsening macroeconomic conditions could potentially heighten SoFi's losses later in the quarter. When you take a look at the numbers that we got here, Ray, they weren't too bad, yet the street taking some issue with maybe what's to come here over the next several months.
Yeah, the big question is really what's going to happen with the student loan crisis and student loan repayment. We're waiting for the federal government to actually step up, and that's what the lawsuit is about. But what we actually think SoFi is kind of the future of banking for the next generation, and that's where people are headed. And that's actually very important because there aren't a lot of fintech players that have gotten to the volume and the density that SoFi has.
It'll be interesting to see if they can get past that student loan headwind and sort of when that does happen, right? We've been talking about this moratorium for a while now, several years now, wondering when that's going to happen. SoFi said today in their report that their student loan volume of just about over 525 million was down more than 50% from the average pre-pandemic volume. And student loans account for about 15% of the loans that SoFi is putting out there. So for that business to be hampered in the short term is definitely a headwind. Of course, maybe not a headwind in the long term, Ray, with some of the potential advantages you're talking about as well.
Yeah, but they could have broken even if they had the student loans.
Right.
And you could see that. It's really close.
Yeah, certainly. That's great to point out. And again, one of the reasons why we're seeing stock under pressure here today, off just about 12% when we look to maybe some weaknesses in parts of their business. All right, let's take a look at GM. General Motors here, shares closing to the upside, up just over 1% off the highs of the day. The automaker cutting several hundred contract workers over the weekend. Now, this is part of GM's goal to cut $2 billion in cuts here by the end of 2024. And this move here, Ray, coming on the heels of the fact that GM announced that back in April, so last month, about 5,000 of its salaried workers opted for that buyout that was offered. So certainly GM still needing to make additional cuts, but the street pretty encouraged by this.
Yeah, the street's definitely encouraged. The Warren Tech plant is really where all the design, the engineering, and of course the IT teams are. And they were using contractors. And I think limiting a lot of the contractors will help them to get to a cost structure. The real question is, can they compete with Tesla for cost in terms of getting an EV out and the unit cost of getting an EV? Tesla has that advantage. And I think GM's trying to catch up by getting that $2 billion of cost out of the market.
And it's been interesting to watch GM be a little bit more careful in that EV space, right? I know Morgan Stanley's Adam Jonas was pointing that out today. He actually upgraded GM earlier this morning, calling it a top 5 auto play and slapping a $38 price target on GM, which does see a little bit of upside there. But he pointed to the fact that they are being more careful with that EV strategy. Remember, they're going to be cutting production of the Volt later this year, and just generally that they're not putting out too many EV vehicles. He said when they had been more cautious on GM in the past, Shauna, it was because they were essentially worried that they get too far out ahead of themselves in this EV production process. So he said he likes that they're moving a little bit slower, so then a company like Tesla can't immediately put pricing pressure down on them, and GM would therefore be slightly overextended. So I thought that was interesting, basically playing it a little bit slower, maybe a little bit safer, and building.
Yeah, I like that take because I think we've heard a lot of the opposite, right? GM, a lot of these traditional automakers have been too slow to adopt to this push that we are seeing in EVs. They still only make up much less percentage, obviously, of the market than Tesla, although obviously Tesla has been losing market share steadily, but you could expect that when you're seeing more entrants into the EV space. GM, though, positioning itself well. We'll see whether or not they're going to be able to maintain some of the momentum that they have seen in the EV space once they do get rid of the Bolt, which we know has really made up for the majority of their EV sales. All right, Josh Schaefer, thanks so much. Ray, stick around here because let's talk a little bit more about the tech sector. And the tech sector is showing some signs here of solid results so far this earnings season. We've heard from Alphabet, Meta Platforms, Amazon, all beating the street's pessimistic expectations last week. So, Ray, when we were coming into this, lots of questions about the rally that we have seen in tech since the start of the year, whether or not that was going to remain intact given the results. What do you think so far this earnings season?
Well, I think we've hit the bottom, right? Digital ads, we thought it was a disaster, but the top 3 players did pretty well. So Google did really well. You saw even though they had slowdown in YouTube, they got subscription growth that was there, right? And you look at what happened with Meta, they surprised everybody with a 3% growth and keeping about 3 billion monthly active users, which is pretty big feat for them. And of course, we saw Amazon breaking out. So the big tech companies have the capability of having the network and having different business models that can monetize on digital ads.
Ray, I'm curious to get your thoughts on here just in terms of the strategy that we have seen from some of these larger tech giants, because Meta did make some comments that it is struggling to advertise on Reels. And then we had the news today that YouTube is giving advertisers a new format here to advertise across Shorts. What's working best in this environment?
Yeah, what's working best right now is just, having a different kind of differentiated ad market, because attention spans have dropped, right? So we've gone from 90 seconds to 60 seconds to basically 30 seconds, and to pop an ad is pretty hard to do that. So it's going to be back to display ad placements, or just very, very in-product type of kind of placements.
What do you think is the realistic timeline here in order to see substantial improvement that we've been waiting for within the ad market?
You know, it's going to be about 3 quarters before we see that, and if you see that shift. Plus, we're going to see the macro conditions change as well. But what's been happening is advertisers are going to where the audiences are. And in fact, that's why you're seeing the big 3 actually do much better than everyone else.
Right, the biggest catalyst for tech valuations here on out. A lot of the hype has been around AI. Is that the investment trade that's going to stay intact here?
Yeah, so the hype on AI is going to be up for the next 3 quarters. You've got to have an AI play in order to be able to, sustain what's going on with your valuations. And AI is driving all the valuations, not because just the cost efficiencies that are there. It's also about the exponential advantages companies will have if they're on the right AI platform.
What do you make of the race here? A lot of the 2 names that come up, at least at this point in the race, it's Microsoft and Alphabet, Google, their entrants here, or not really entrants, I should say, their growing presence within the AI space. They've been in the AI space now for quite some time with Bard. Who's winning?
So it's really tough to say, and here's why. It's a 2-horse race. Microsoft, at the beginning of the year, I heard from a lot of partners and a lot of people that Satya Nadella basically said, we're going to declare war on Google, and they have. And what is happening is basically Google was slower to the market. They might have had better technology, might have better teams, but they're balkanized, and their organizational structure makes it very hard for them to collaborate the way Microsoft is much more top-down, and so they kind of launched all the ChatGPT, the Copilots, and went full on against Google for digital ads, as well as where they were going with their OpenAI investment. So it's a 2-horse race, and it's going to be interesting to see what happens. But the bottom line is we might not have enough data to be able to do all the things at a level of precision. So if your AI physician is 93% accurate, would you do it? Probably not. But if your search for, checking what's going on for self-help on a contact center call is 83% accurate, that's a win. And so we're going to see different gradations of where AI plays a role and what your comfort level is going to be.
So it sounds like you think Alphabet maybe has a chance here in catching up to Microsoft where they are in AI.
Oh, I think Alphabet definitely has a chance. And here's why, because they've got the better data centers, they got the better algorithms, but they've got to get themselves organized.
What kind of impact do you see this having on jobs? Because on one hand, there's the argument that AI is going to eliminate jobs. On the other hand, it could create some. What do you think?
We're definitely getting new types of jobs, right? Prompt engineers, one that keeps popping up, like how do you write the prompts to get the questions right? And the other one is a little dystopian. It's called the kill switch engineer, right? So who's going to pull the plug on AI when they come after us?
But in terms of, I guess, how recent graduates should be thinking about entering the tech space, right? AI's impact on that. How do you see that reshaping that workforce?
Yeah, it's very different, right? If you're on the creative sides, right, you suddenly have access to so many more new ideas. You can get a creative from concept to market instead of 30 days. You can probably do it in like 3 hours. And so that means you have to get really good at curation. You have to get really good at design. But the good news is you can do it much more quickly. If you're writing a paper or if you're actually coding, right, now snippets and codes are actually going to be reused very, very quickly. And so now you got to get really good at finding bugs or finding errors. So you change the skill sets that you're using, just like, back when I was in school, like you couldn't bring a calculator to an exam. Now everyone has these super graphical calculators that are doing all these kind of things.
What about regulation within the space? Because Elon Musk was one of the initial investors here in OpenAI years ago. He met with Senator Schumer recently, just last week, talking about the need for regulation within AI. How do you see that taking shape? How do you see that affecting the industry?
Yeah, we're going to need a lot of help, and it's really around the content. Part of the challenge is that we are at a point where we have exponential misinformation and disinformation coming at us, and we're not going to know what's real anymore. So we've got to be able to tag content, understand what content can't be ingested, address copyright laws that are going to happen, derivatives are going to pop up as well. But we also need to have a couple of levels of ethics. First, algorithms need to be transparent. We need to understand what's going on. We make decisions by bias, but if you have unwanted bias, we actually have to be able to understand what's happening with that. So it's got to be explainable. But once you have that in place, how do you reverse things, right? So you're discriminating against left-handed people with purple hair. Oh, I'm so sorry. How do we actually reverse that so we learn from that? And of course, we have to train this over time. And then the last piece is, if you don't have a human in the loop, well, you might not want to know what may happen next.
Yeah, it'll be a little bit scary to think about. All right, Ray Wang, always great to have you here. Thanks for coming on set here with us. Coming up, we are moving on here into the auto sector. We have Jamie Dimon actually to the rescue again. We break down what the First Republic deal means for JPMorgan next.
Brian Sazia, Yahoo Finance here at the 26th Annual Milken Conference in California in the posh Beverly Hilton. As you can see, the stars are arriving. Lots of the biggest names in business and global business and government here at the conference. Yahoo Finance is on the ground all week long for this conference. The biggest thing I'm most interested in, where's everybody's head at in light of what is happening with First Republic? We're seeing a bank right there on the brink of receivership. We have not seen this stuff since the great financial crisis, but we're going to get to the bottom of it all at the 26th Annual Milken Conference. Tune in all week.
JPMorgan taking over troubled First Republic Bank. The failure of the regional lender is the second largest in U.S. history. What it means for JPMorgan, also what it means for the broader banking sector. For that, we want to bring in Ken Liani, CFRA Director of Equity Research, and Dick Beauvais, Odeon Capital Group Financial Strategist. It's great to see you both. Ken, let me first start with you. Whether or not this is a good deal for JPMorgan, what do you think?
This is a good deal. It's a clean deal for JP Morgan. Unlike 2008, where the large banks were part of the problem, they certainly waited until this bank had to be put to FDIC. And there's lost share agreements, so there's not going to be much risk to clawbacks in the future. They do add deposits and also a pretty good wealth management business. So incrementally, in the scheme of things for JP Morgan on deposits, it's less than 4%, but they incrementally add some assets and do a good thing to show the country that we don't have systemic risk here. But I think for Dick, with his stellar banking career covering regional banks, that's questionable on what will be the new business model where deposits are a little bit more sensitive and not long duration, and how you match up assets and liabilities for a lot of the smaller banks. It's going to be a real challenge looking ahead, not only now, but over the next 3 to 5 years.
Well, Dick, I'd love for you to weigh in there just in terms of how you think this potentially reshapes or really influences the future here of banking.
Well, I think Ken is right. It's going to have a major impact on the future of banking. I think that I do believe it's a systemic risk here. I think that this is a replay of the situation in the mid 1980s when the Resolution Trust Corporation was set up, and all the about 1,000 S&Ls went bankrupt. Basically, what the regional banks are facing is rising costs for their deposits as a result of the interest rate increases, and as a result of those same interest rate increases, declining value of their assets. So you reach, a junction point where at some point you're now looking at your deposit costs exceeding the yield that you're getting from your assets, and you've got a problem. And I think the JP Morgan acquisition exacerbated that situation, because while, everybody's running around saying that the bank deposits in the United States are guaranteed, whether it's the president, the secretary of the Treasury, or other individuals, the fact of the matter is that people who lend money to banks are not protected. The people who have preferred stock holdings in banks are not protected. And JP Morgan underlined that very clearly today, that they were not going to cover either of those entities, which means that, regional bank ratings are likely to fall. Their access to the capital markets are likely to be contracted. And as a result of that, as Ken clearly said, 3 years of difficulty in this area, I think, is a modest assumption.
Dick, are there risks of more failures? This is the fourth lender here to collapse this year. Could more be on the brink?
Oh, I think there's absolute certainty of it. Just think about the fact that, people made a huge amount of money here, right? In other words, those people who have driven SVB out of business, who, benefited from the Signature failure, who benefited from the First Republic, slow die, they made a lot of money. And then now looking around to find another target, another bank, which is in a position where they're going to go under. And what they're looking for is, does the bank have a large portfolio of fixed rate mortgages? Does the bank have a huge amount of commercial real estate? Does the bank have, a huge gap between its real if you will, values and its published values. In other words, when you pick up the bank statement and you see it's got X, Y, Z in assets and ABC in equity, do they really have it? Or do they have a number that they're publishing which fails to recognize marking to market? So, they'll be out there. They're prowling. The antelopes are being prowled by the lions here, and the lions are going to find other ones to attack and bring down. So, yes, there will be more bank failures.
Kim, when it comes to what's happening with the larger banks, with this acquisition from JPMorgan, obviously the largest U.S. bank here by assets is getting even bigger. We know that there's been some criticism from certain sides of the aisle. Senator Warren, in a tweet today, saying that the failure of First Republic Bank shows how deregulation has made the too big to fail problem even worse. What's your response to that? Because the flip side of it would be that people should be thankful that these banks are too big to fail and they're able to come to a rescue at a time like this.
It's a wasted conversation. And quite honestly, Dick's points are well taken on where there can be risk for the regional banks, smaller banks. They're going to have more capital liquidity risk. But I would note it's going to come from other parts of the financial system where we have the next big issue. It could be the shadow banks. It could be those who are lending aggressively into consumer and credit risk. Should we have some form of recession in the second half of this year, will begin to pop up. But there's no distressed industry out there yet. I cover office real estate, and that is basically something that will take months to years. It's not going to be a blow up and you can refinance or change the loans, but it is an issue. So overall, again, I think the Fed and other regulators are buttoning up the banking system, and they missed this big time. They need more staffing, not just bringing their C team to cover banks with over $100 billion of assets. And when we look ahead, it's going to be the shadow banks and other areas that I think is going to be part of the news.
Dick, what do you think is the one takeaway that we could really have just in terms of Jamie Dimon's not only influence, but the fact that he has come to the rescue a number of times within the banking sector, not only today and what's transpired over the last several weeks, but a number of times, particularly with Bear Stearns 15 years ago, the biggest lessons that we can learn? What do you think that is?
Well, that there's an understanding within the industry that the FDIC doesn't have any money, right? In other words, the FDIC has less than $100 billion, by my estimate, at the current time, to cover $10 trillion in insured deposits. And they're arguing, if you're the president of the United States, $20 trillion in total deposits, and they can't do it. They can't do it. They don't have the money. The Federal Reserve is sitting with a real net worth deficit of $1 trillion. The Federal Reserve lost $15 billion in the fourth quarter last year. They can't do it either. So who is going to do it? Who is going to protect, the other banks in the country? And the fact of the matter is that it's got to be the huge, monolithic banks that we now have. And of course, JPMorgan Chase is the best of the breed. By the way, I think, you ought to pick up on Ken's thought. I mean, the shadow banking system is going to be disastrous, in the next few quarters, if in fact we basically have a recession, and maybe even if we don't have a recession, because there are no insured deposits in the shadow banking system, and people are not going to start running in and lending money to these commercial lenders in an environment like we have right now.
Yeah, something, of course, that could potentially have big implications. Dick Beauvais, Ken Leon, great to have you both on together. Thanks so much. Well, coming up, we shift gears to the auto sector. We're joined by the CEO and president of Mercedes-Benz USA. Stick around.
We've got a huge week for investors, big-time corporate earnings, a potential writer's strike in Hollywood, and oh yeah, the Federal Reserve's got a major decision on interest rates. Here are the 3 things you need to know for the week ahead.
Markets are bracing for some major earnings. Apple, Ford, Starbucks, and AMC are just a few of the top companies reporting quarterly results. Those will give us a fresh look at the health of American business. Plus, Hollywood's movie and TV writers could walk off the lot as early as Tuesday. The Writers Guild of America has voted in favor of a labor strike, giving studios until May 1st to agree on a deal. If a strike occurs, production of some of your favorite TV and film franchises could be delayed. And last, but definitely not least, the Federal Reserve makes its decision on whether to continue raising short-term interest rates. Signs of a slowdown in the U.S. economy could give the Fed reason enough to pause on their current rate hike policy. We'll hear from Chairman Jerome Powell on Wednesday. We've got you covered all week right here at Yahoo Finance. And be sure to tune in to After the Call on Tuesday and Thursday for a breakdown of some of the big earnings reports.
Mercedes-Benz rode the strength of their top-end segment and premium van sales to a first-quarter earnings beat. Joining us now to discuss the road ahead, we want to bring in Dimitris Zilakis. He is the Mercedes-Benz USA CEO and president, as well as Yahoo Finance Autos reporter Pras Subramanian. Dimitris, it's great to see you here. So certainly Mercedes-Benz coming off a very strong first quarter. A lot of that attributed to the sales that we saw in some of your top-line vehicles. Do you see that trend holding here for the remainder of this year?
You're absolutely correct. You had a very good start this year based on what we call top-end vehicles, or our luxury top-end vehicles. G-Class, S-Class, GLS had an extraordinary good start. We do believe that based on the demand we have, based on the pre-orders for these products, but also in new models which are coming in the second half of this year, we'll continue having a successful story with our luxury top-end vehicles.
Hey, Dimitri, Pras here. So why is your clientele actually going more upmarket in this sort of market that we're in right now? Why are they spending more and more money on these higher end cars, top trim cars?
I would say it's based on what these products are offering. These are totally new cars, nicely designed, very attractive, with good new technologies, high performing, with elements of exclusivity, individuality, which can be built upon the customer style and character, let's say, which makes these products attractive. So I think it's basically attractivity for our products.
Can the momentum hold up if, in fact, we do see a global slowdown in the second half of the year?
Sorry, say it again.
Can that momentum that we have seen, the fact that the top end vehicles continue to sell, can that hold up if we do, in fact, see a larger global slowdown?
For the moment, we have a quite good order backlog, which takes us well into the second half of the year. And as I said previously, we have a couple of model launches in the second half, like the SL43, for example, AMG, which is coming up in June. We have the EQS SUV Maybach, our top-end electric vehicle, being produced in Tuscaloosa in US. So we have products which we believe will hold up on demand.
Hey, Dimitri, I also noticed the core and the entry-level models in the US at least actually saw some healthy gains there. I know the company wants to focus more on the top end. Is there still a market for those entry-level and core customers? And do you think Mercedes should try to address that, or are they is it the better move to kind of de-emphasize that?
I think we have a quite balanced portfolio, which is, as you said, spreading between the entry, core, and luxury end. And also good offerings in terms of electric vehicles, but also of internal combustion engine. If you look at the moment in the month of April, for example, we have launched the new GLC, which is actually our bestseller in the US markets. An SUV, it's a great car, good design, good performance, and that obviously helps in raising the demands in this segment. But away from that, we also launched, also in April, our electric EQE SUV, which is built in Alabama. So we have two products, an IC, an electric vehicle, brand new in the market as of April.
What are you seeing in terms of the pricing war that's playing out? I know a lot of the pressure has been more on those mass market cars, but are you seeing any pressure on the higher end side of things?
Obviously, there is pressure in the market, and always the customer has to make a choice, first of the brand he trusts, but also of the product which fits best his wish. And I think there, we as Mercedes were very well positioned. Different products in different price segments with different performance characteristics, and that gives us high demands at the moment in the market.
So Dimitri, what about the sort of we're seeing that volumes increasing here from Mercedes globally and in Q1 here in the US. Is that an indication that the supply chain crisis, the parts shortages are coming to an end?
I would say it's getting better. Still, we have a lot of challenges and have lots of instability in the supply chain. But on one hand, will learn to live and manage the situation better. On the other hand, yes, supply is improving. So all in all, it's a better situation, better plannable, I would say.
So Dimitri, one last one here. I know you guys have, I think, 5 EVs out in the market here in the US, so the rollout is happening now. But I also heard that in China, those higher end customers want to keep gas-powered cars. They want gas-powered cars for their top-end models. Are you seeing that sort of kind of rub there in the US? Do US top consumers want gas-powered cars still?
I mean, our V8s are selling still extremely well. So we have a balance of all offerings, electric vehicles, high performing, AMG, even electric, but also our traditional V8s and our AMG portfolio. Both of them attractive, both of them serving different parts of the markets. And why not? You can have your electric, but you have also still your internal combustion engine, your AMG in your driveway.
Room for all involved. All right, Dimitris Zilakis, thanks so much for joining us. Mercedes USA CEO. And of course, our thanks to Pras as well. All right, coming up, earnings season rolling on. We'll tell you what to watch from tomorrow's Starbucks report on the other side of the break.
Chipotle is operating their own stores, and they want to be extremely prudent about making sure that the operations for their employees and the customer satisfaction is extremely high across their entire system. They start in a lab, really, they move it onto a single store, then they roll it out into 10 or more stores, and then eventually it gets rolled out nationally. One of the things that they are investing in is this new grill system. The current grill is one-sided, so you have to put the chicken on the grill. You have to let it stay for about 6 minutes each side, and then you have to flip it. So in total, it takes about 12 to 13 minutes to grill the chicken the Chipotle way. This new grill is going to be kind of a double-sided, so it's going to take half as much just because it's already kind of cooking from 2 sides. But on top of it is also like faster grilling times. So in total, instead of taking 12 to 13 minutes of cooking, it's going to take only 2 to 3 minutes. So there is a huge potential for Chipotle to increase the speed of service of people who are waiting in line. So having a grill that can help you really speed up the process and cook the chicken in only like 2 to 3 minutes is really going to help the customer have what they want when they want it.
Over the last week, thousands of people have been laid off from companies such as Gap, Dropbox, and Lyft. And many of those individuals were likely offered severance packages. But did you know that you may be able to negotiate some parts of that severance package? Yahoo Finance contributor Mandy Woodruff-Santos is here to tell us what we need to know. She's also the co-host of the Brown Ambition podcast. Mandy, it's good to see you. So what are the sort of things that people might have on the table to negotiate in a severance package?
Right. Well, I think in the first place, if you get a severance package, be grateful because it is not necessarily a requirement, although it is becoming a trend. Companies want their employees who are being let go to at least go away with something so they're not, dragging the companies online, which I definitely don't recommend. I think number one on employees' question is, can I negotiate how much I get? There's good and bad news here. Depending on the size of the company and the size of the layoffs, you may be able to ask for more. But if you're part of a mass layoff, like we're seeing at these tech companies, it's unlikely that they're going to make an exception just for you. Does it hurt to ask? Probably not. That's why I encourage workers to definitely take their time to read their packages before they sign them. Beyond the actual pay, think outside the box. What about if you have equity? What about if you have equity that's not vested yet? You may get them to accelerate your vesting period so you can cash out before your last day. What about checking to be sure that they are adding up your unused vacay and your vacation and sick days so that you're getting paid accurately for those? You can also ask for things like job placement assistance, resume coaching, health benefits. If you're not happy with how long they continue to cover you under your health plan and you have a great case, like if you have someone in your family or including yourself who, has a super, a high need for that kind of health care, you may ask them, can I have additional time where you are covering my policy? Even a bonus payout. There's more than you can negotiate. I want people to think outside the box than just the actual check that they're going to walk away with.
Amanda, I think a lot of people, unfortunately, when they do find themselves in this position, they're in a state of shock. They don't know what to do. They can't believe that they just heard the words that they are being laid off. Why is it important not to rush in and sign anything right away?
Well, of course, I don't think anyone should be signing any legal document in a state of high intensity emotion, which no matter if you saw it coming or it's the first you've heard of it and they were totally blindsided, you're going to be going through the feelings. And I want you to have time to do that. With a severance package especially, there's usually not a need for you to sign it right away. And whether it's you taking 24, 48 hours to just read it through thoroughly with your partner, with your family, to be sure you understand the ins and outs of it, or you may even want to have, an attorney who potentially on a pro bono basis might just review it for you. It's smart to take your time and to review it because it is a legal document. And they may even be asking you to do something like sign a non-disclosure agreement where you can't talk bad of the company or, just not necessarily work for their competitors. So those are some clauses you really want to pay attention to. That's why I absolutely encourage you not to rush to give that John Hancock.
And Mandy, when it comes to some of there was one caveat that jumped out to us here in your piece, and it said success isn't guaranteed. Why do you say that, and what do you mean by that?
Well, I think with any negotiation, you have to think about how much leverage do you have in this situation. And I think in the position of someone who's being let go, but given a severance package, the company may feel, hey, look, we're giving you something. It may not be what you would love. And especially like I stated earlier, if you're part of a huge company that has done mass layoffs, those have been extensively reviewed, potentially by the board, certainly by the higher ups in an HR, by their legal department. They're not going to want to go and tinker individual, severance agreements for individual people. So you may have to adjust your expectations of, am I going to get a one-off deal here? Because if word gets out that they gave, Mandy a big bump in severance pay, then everyone else is going to be lining up down the block, right? So you want to go in with realistic expectations and just genuinely think of what would put you in the strongest position so you can chart a new path for yourself and go into this new chapter strong.
Certainly important things to be thinking about. Mandy Woodruff-Santos, as always, thanks so much. I want to get to Starbucks. Starbucks is set to report its fiscal second quarter earnings results on Tuesday. Brooke DePalma following that with us. And Brooke, what can we expect?
Yeah, well, this will be Laxman Narasimhan's first earnings call as official CEO. Of course, Narasimhan was set to take the role on April 1st. He joined back in October as incoming CEO, but he joined about 2 weeks earlier on March 20th. So once again, this will be his first call. Starbucks confirming that to Yahoo Finance that he will be leading the call on Tuesday. Now running right along to another focus for investors here, sales momentum in the U.S. Lots of investors waiting to see if U.S. consumers still see Starbucks as an affordable luxury in a more difficult macro environment. One analyst saying that he aims to focus and is looking to hear more on the resiliency of U.S. sales momentum in that more difficult macroeconomic environment. Of course, that word resiliency, something that we continue to hear across the board this earnings season. Now moving once again right along to the third focus of Starbucks investors call is improvement in China, as China's COVID-19 related recovery may be in the rear view. Here. Wedbush analyst Nick Saden saying, quote, while visibility into the trajectory of a recovery in China remains relatively limited, it is clear that the multi-year headwind has now turned into a tailwind. Important to note here that Starbucks opened their 6,000th store back in September. So certainly lots of momentum in China as that COVID-19 related recovery seems to be in the past.
All right, so that's what we're supposed to expected to see in terms of sales growth in the U.S., but then also some improvement, it sounds like, maybe over in China. What about pricing? Because pricing pressure, pricing power, where does Starbucks stand?
Yeah, well, certainly we've seen them increase menu prices in the past year, and specifically in the U.S., that's one of the things that analysts say that's going to increase same-store sales. We're seeing same-store sales here in the U.S. expected to be up 8.91%. Elevated pricing is expected to be a driver here in the U.S. Not so much mentioned overseas in China as they continue just to push through those headwinds of COVID-19 related recovery. But the average check size is expected to go up here in North America, up 6.25%. International, the ticket growth is expected to be up 3.42%. Now, other things that are expected to drive growth here in the U.S. is food attachment, like adding a slice of pumpkin bread to orders. In addition to product innovation, we're looking to hear more on that Oleato coffee line. And of course, overall, just looking to hear more on that consumer demand here in the U.S. as inflation continues to take a toll on Americans' wallets.
All right, we will have that earnings report for you after the bell tomorrow. Brooke DePalma, great stuff. Thanks so much. And be sure to tune in tomorrow. For me, Brad Smith, we are going to be breaking down the Starbucks earnings call, the latest edition of After the Call that gets underway as soon as the earnings call wraps up, probably right around 6 p.m. Eastern time. Well, coming up next, we check back in at the Milken Institute Global Conference as Brian Sazi gets ready to speak with the CEO of Mattel. We'll be right back. Hollywood writers and production studios are engaging in last-minute talks to avoid a writer strike. Yahoo Finance's Alexandra Canal here with the details. Ali, where do those talks stand?
Well, right now they're in 11th hour negotiations. There are sort of three things that can happen. They can reach a last-minute deal, they can reach a short-term deal, they can reach an extension that seems unlikely, or as early as tomorrow, Tuesday, those writers could walk out on the strike. And if you think about the economic impact, it's going to be dire, especially the longer that this strike continues, because it's not just writers, it's also the production crew, it's stagehands, it's all of those ancillary businesses that are Hollywood dependent, like catering companies, limousine companies. If we take a look at the last writer strike, which happened 15 years ago, it lasted 100 days between November 2007 to February 2008. It cost the LA economy an estimated $2.5 billion. Now that included wages lost by those writers and other workers during the shutdown, along with those Hollywood dependent businesses that I mentioned. And, you know, although Hollywood is vital to the LA economy, writing and production, they're very important industries for other U.S. cities as well, like Atlanta, New York, Chicago, just to name a few. So the longer this continues, the harder things are going to get. For the immediate impact, that's going to hit soap operas. It's going to hit late night talk shows like SNL. In terms of your favorite streaming shows and cable shows, it's likely that there will be a delay when it comes to some of those productions. If it goes longer, right now, we probably won't see an immediate impact. We've heard from studio executives from Netflix to Warner Brothers Discovery who have said we have a lot of bankable content preparing just in case a strike does happen. And then on the film side, because of that long production time, it's unlikely that we'll see any impact to the 2023 slate. But 2024, if this continues through this summer and into the fall, that could be impacted as well. So we'll be watching those negotiations very closely.
Certainly a lot is at stake, and Hollywood sounds like has the potential to really be disrupted by this. Ali Canal, thanks so much. Treasury Secretary Janet Yellen warning that the U.S. could breach the debt ceiling as early as June 1st. In a letter to House Speaker Kevin McCarthy, Yellen writes, after reviewing recent federal tax receipts, our best estimate is that we will be unable to continue to satisfy all of the government's obligations by early June, and potentially as early as June 1 if Congress does not raise or suspend the debt limit before that time. Now, this puts added pressure on Congress to get a deal done soon. More market coverage coming up on the other side of the break. We'll be right back. Toy maker Mattel trading down a little over 1% here since the start of the year. The toy industry overall has seen inventory challenges amid a larger slowdown. But looking ahead, there could be a number of potential catalysts. Now, that includes a licensing partnership with rival Hasbro. We'll get a Barbie edition Monopoly game out of that union. Speaking of Barbie, the hotly anticipated Barbie movie is out in theaters this summer, July 21st. Let's head back to the Milken conference out in California. Yahoo Finance's Brian Sozzi sitting down with the CEO of Mattel. Brian.
All right, thanks so much, Shauna. Yes, joining me now is Mattel CEO Anand Krize. Good to see you in person for a change, Anand.
Good to see you too, Brian.
So the mood here at the conference, I wouldn't say gloomy, but a little bit realistic. Everybody's acknowledging an economic slowdown. You're fresh off of your earnings report. How has the slowdown impacted toy demand?
Well, from where we sit, we saw a decline in the toy industry in the first quarter. But we do expect the industry to be flat to slightly up. And for Mattel, we saw increase in consumer demand for our product. In fact, we grew consumer demand in all of our leader category, dolls, vehicles, infant, toddler, and preschool, as well as in action figures and building sets. So we saw growth, and we expect that growth to be positive for the full year as well.
Do you already have visibility into the holiday shopping season? Is that why you're so confident in the second half of the year?
It's too early to tell how the holiday season will shape up, but we have some meaningful drivers for Mattel for the full year. From the launch of Disney Princess and Frozen, which is added to our dolls portfolio, Trolls, Wish, two big movies that will launch at the second part of the year, the global rollout of Monster High, and of course, the release of the Barbie movie in July that will be a catalyst. So we have a few incremental new drivers for our business in 2023.
Well, I'm going to make viewers wait to talk more about that Barbie movie because I know they're very excited about. But that that Frozen license, how big is that for Mattel this year, sales-wise?
It's important and it's meaningful, both culturally as well as a business opportunity. We really believe it will be a win-win situation for Mattel and Disney, and we can grow this franchise and leverage our capability and leadership position in the dolls category in a meaningful way.
The writer's strike that we're looking at in Hollywood, does that impact your business at all in terms of movies getting out, content being produced, impacting the toy business?
It will not impact, of course, the Barbie movie, which is out soon, but we're looking to see how it will impact the rest of the business. Of course, we have multiple projects in the making. Some are relatively advanced than others, and we'll have to continue to watch the space and make sure that we manage it properly.
I still feel as though investors don't understand what you're doing on the content front. So let's take them through it. How many pieces of content did you have in development over the next 2 years, and what are some of the big names outside of the Barbie movie?
We announced 14 projects in development. We have Hot Wheels as a project with J.J. Abrams to produce at Warner Brothers, Matchbox, which is being developed by Skydance. We have a Rock'em Sock'em Robot with Vin Diesel and Universal. We have Major Matt Mason that we're developing with Tom Hanks and Akiva Goldsman as a writer. We have a Barney movie in development, Masters of the Universe, Barney, with Daniel Kaluuya. We announced that. We have Thomas the Tank as a film in development. We have several projects in the making, and you can see that the diversity by genre, by audience demographic, by type and feel of each project is very different, which is exciting because we really have an opportunity to capture value from our intellectual properties outside of the toy aisle. And this is obviously not just the Barbie movie, but multiple projects, different partners, all quality, focus on quality of this project. This is not just to sell toys, but really to participate in the film business right at center stage with the best talent in the industry.
Let's get to Barbie, July 21st. How big of an event is this for a company like Mattel?
Look, we really believe this will be an event not just for Mattel, but we believe it will have an impact broader than that. And this is about franchise management. This is not just about one quarter or about 1 year. This is how you manage a franchise. And this film is really being developed by one of the most creative and prolific filmmaker of our generation, with Greta Gerwig, who co-wrote it with Noah Baumbach. She's directing. We have an incredible cast led by Margot Robbie and Ryan Gosling, Will Ferrell, and other top lead talent. We're very excited about it. But this is not just about the quarter. And this is the first of an exciting film slate that we're pointing out, as I mentioned before.
I think this was you mentioned on the last earnings call just a couple days ago. You said this movie was a legacy-making moment for Mattel. Explain that to us.
Yeah, this is the first time that Mattel is putting a movie out based on any of our IPs, any of our franchise. Barbie is clearly an important brand. It's one of our 3 power brands. And it will be, in many ways, a showcase for the quality of the movies that we're looking to make, the type of partnerships we're formulating with lead talent in Hollywood, working with major studios, and of course, amplifying the brand and the movie through our own marketing capabilities and social reach and engagement. So it will be a way for us to show what does it mean when we say that Mattel is an IP-driven, high-performing toy company, and an opportunity to extend our business outside of everything we do on the toy side of the company.
Speaking of partnerships, you just signed a partnership with Hasbro. Now, when I saw this news cross I thought this was like Apple and Google joining forces to make some piece of new hardware. Take us through this deal, because I don't think a lot of people even saw this coming.
Yeah, this is a cross-licensing agreement where we are integrating Transformers into Hot Wheels and Uno, and Monopoly is integrating Barbie into its play. Now, we do that with other parties as well. We do it with other toy companies, we do it with entertainment companies.
No, this is Hasbro.
Clearly, this is the first time it happened, and it's really going to be a case where we both win from this partnership, but the real winner is the consumer, the fans, that will have more ways to engage and interact with their favorite brands.
Is there more to come on the Hasbro-Mattel front?
At this point, this is the partnership we agreed on, but we constantly look to innovate and partner and collaborate with parties where we have an opportunity to create something unique and exciting.
Lastly, before we let you go, I followed your transformation journey in Mattel, everything you've done. What's next for you, and what's next for Mattel over the next year?
Yeah, it has been an exciting journey. Just a few days ago, we reached investment grade rating. This was a milestone moment for the company, capping a 5-year journey of taking the company from a negative more than 200 million operating income loss, adjusted operating income loss, to positive $689 million of adjusted operating income. So financially, it's been a transformative period for the company, and we believe there's so much more to come, both on the toy side of the company and everything we do on the IP side of the company, the entertainment side of the company, in film, television, licensing and merchandise, consumer product, and of course, digital experiences. So we believe we are still on an exciting journey with a lot more to come.
All right, we'll leave it there. Mattel Chairman and CEO Ynon Kreiz, good to see you. And July 21st, I will be at that Barbie movie, definitely seeing it, and I will be sending you a photo. Ynon, good to see you in person.
Thank you.
Back to you guys in New York.
All right, great job there, Saz. And of course, our thanks to Mattel CEO Ynon Kreiz. Well, it is closing time here at Yahoo Finance. Here are some of the biggest stories of the day. First up, JPMorgan buying most of First Republic's assets after the bank was seized by regulators, making First Republic the second largest bank failure in U.S. history. JPMorgan CEO Jamie Dimon saying that the purchase will help stabilize the banking system, adding, quote, "This part of the crisis is over." And another escalation in the ongoing battle between Disney and Florida Governor Ron DeSantis. The board appointed by DeSantis to oversee Walt Disney World's operations has voted to sue the media giant. This is the board's response to Disney suing it, which accused the board and DeSantis of punishing the company for exercising its First Amendment rights. And finally, Lordstown Motors warning that it may have to file for bankruptcy if an investment deal with Foxconn falls through. Now, in a filing, the EV maker saying that Foxconn accused the company of being in breach of an investment agreement due to a delisting notice from the Nasdaq. As a result, Foxconn is threatening to back out of the deal if Lordstown does not fix the issue. Lordstown shares ending the day down just about 23%. That'll do it for us today on Yahoo Finance Live. Be sure to come back tomorrow, 3 p.m. Eastern Time. We'll see you then.